Nuburu Inc. is currently trading at a price of 0.18 USD as of the market close on January 16, 2026, which represents a decline of 4.14% for the day. In the after-hours session, we are seeing a fractional upward tick of 0.91%, bringing the stock to approximately 0.18 USD. To the casual observer scanning a ticker list on the Robinhood app or looking for quick gains on high-volume penny stocks, this sub-quarter valuation looks like a company on its last legs. But the reality that hit the wires just 48 hours ago is that Nuburu has officially activated a sweeping industrial alliance with the Italian defense titan Tekne SPA. This isn't just a memo or a non-binding agreement. It is a full-scale network contract that includes a €13 million convertible loan and the transfer of equity. While the market expectation is that this is another struggling microcap circling the drain, the reality is that Nuburu is being systematically dismantled and rebuilt as a focused defense tech platform. The tension between its penny stock price and its high-stakes military partnerships has created a massive curiosity loop for anyone tracking the industrial sector. When you look at your positions on the Fidelity mobile app or monitor the intraday swings through the interactive brokers platform, the red numbers on Nuburu tell a story of past failures. The stock is down significantly from its 52-week high of 0.85 USD, and many investors who bought in during the 2024 hype have long since moved their capital into more stable names like Nvidia stock or Apple stock. However, the move we saw today, a 4% slide on a volume of over 22 million shares, suggests that a lot of retail traders are exiting before they understand the January execution milestones that management has laid out. The expectation was that the company would need to constantly dilute its shareholders just to keep the lights on. The reality is that they have secured a $23 million financing agreement with YA2PN Ltd, which gives them the runway to complete the acquisition of the Italian blue laser firm Lyocon and increase their stake in the critical infrastructure software firm Orbit SRL. If you're using Schwab Intelligent Portfolios or other automated investment tools, you probably don't have direct exposure to BURU because of its microcap status and the extreme volatility that comes with it. But for the self-investing individual using a Robinhood Investments account or a Fidelity brokerage account, the reality of this company is found in the physical properties of light. Blue lasers are inherently more efficient than traditional infrared lasers for welding high-conductivity metals like copper and aluminum. This is a technical fact that hasn't changed despite the stock price movement. The expectation was that Nuburu would dominate the EV battery manufacturing market. The reality is that the EV slowdown forced them to pivot. They are now taking that same blue laser physics and applying it to electronic warfare, counter-UAV systems, and 3D printing for military special purpose vehicles. This is the defense and security hub transformation that is currently being ignored by the broader market. The institutional activity in Nuburu is currently minimal, which is typical for a stock at this price point. However, the fact that they are now partnered with Tekne, a company valued at roughly $60 million that builds specialized military hardware, provides a level of industrial backing that most laser startups lack. According to the latest filings available on interactive brokers trading platforms, the company is targeting early 2026 for the first revenue drops from these joint ventures. The expectation among bears is that these contracts will never materialize. The reality is that they already have €10 million in contracted value scheduled for delivery throughout this year. When you're online investing, it's easy to get caught up in the price is truth fallacy, but in the case of BURU, the price is reflecting a history of debt and the contracts are reflecting a future of industrial integration. For those managing an individual brokerage account, the technical indicators are a mess. The stock has been a sell candidate on most automated investing sites for weeks. But if you look at the RSI, it is currently hugging the bottom of the range, suggesting that the selling pressure might finally be exhausted. If the company can close the Lyocon deal and finalize the Maddox Defense joint venture by the end of this month as promised, we could see a massive reevaluation. On the SoFi trading platform, the sentiment is often a leading indicator for these small-cap names, and we are seeing a growing number of bullish flags as retail traders realize the company is effectively being integrated into the European defense supply chain. Comment below how many shares of Nuburu you currently hold, or if you've decided to stick with large-cap tech like Tesla stock instead of chasing these high-risk defense turnarounds. Let's talk about the business model change. In 2023 and 2024, Nuburu was a pure-play laser manufacturer. They made a box, they sold the box, and they hoped the customer liked the box. Today, they are moving toward an integrated solutions model. By acquiring firms like Lyocon and partnering with software experts like Orbit, they are creating a full-stack defense platform. The expectation was that they would be a supplier to the big defense firms. The reality is that they are trying to become a prime contractor for specific niche applications like mobile additive manufacturing in the field. This is a much higher margin business. If you are into self-investing and use the SoFi Invest app or Fidelity trading platform, you know that the multiplier on a defense software company is much higher than on a hardware company. The financial health of the company remains the biggest reality check. In the most recent 10Q filing from November, they reported a net loss of over $22 million. That is a massive number for a company with a market cap of under $80 million. The expectation is that this burn will continue indefinitely. The reality is that much of that loss was tied to non-cash items and the costs of the corporate restructuring. They currently have about $6.8 million in cash, which is a tight runway. This is why the YA2PN financing was so critical. Without it, the company wouldn't have survived the winter. If you're using investment help from professional advisors, they will likely tell you to stay away from a company with this kind of balance sheet. But for those who manage their own Fidelity IRAs or Robinhood fractional shares, the risk is the point. You are betting that the revenue from the Tekne partnership, which includes military vehicles for Bangladesh and electronic warfare platforms for Ukraine, will hit the books before the cash runs out. Older reports from 2025 show a company struggling to maintain its NYSE American listing. They had to deal with several deficiency notices. The expectation was that they would be delisted and moved to the over-the-counter markets. The reality is that they have managed to stay listed by executing these strategic deals and bringing in new leadership like Alessandro Zamboni. This resilience is often a sign of a bottom in the stock's life cycle. On the interactive brokers platform, the borrow fee for shorting BURU has spiked recently, which means the easy money for the bears has already been made. If the company can deliver even 1 quarter of positive operating cash flow in 2026, it would be a shock to the system that could trigger a violent upward move. The competitive landscape for blue lasers is also changing. While IPG Photonics and other giants have their own laser solutions, Nuburu holds a significant patent portfolio specifically for high-power blue diodes. The expectation was that these patents would be their only value. The reality is that the patents are now being weaponized, both literally and figuratively, to win defense contracts. Their recent NASA contract for lunar power transmission using blue lasers is a perfect example. While $850,000 isn't a lot of capital, the seal of approval from NASA is worth its weight in gold when you are bidding for Department of Defense work. If you're looking for online investing opportunities, these pre-revenue defense plays are where the most growth can be found, provided you can handle the 5% daily swings. Looking ahead, the catalysts for Nuburu are very specific. First, we need to see the official closing of the Lyocon acquisition. That gives them a European manufacturing base. Second, the partnership with Maddox Defense for UAV solutions needs to show a physical prototype. Third, the network contract with Tekne needs to produce its first invoice. The expectation is that these will all take years. The reality, according to the December 30th press release, is that these are January 2026 execution milestones. We are talking about weeks, not years. This mismatch between the market's long-term skepticism and the company's short-term aggression is where the opportunity is hidden. For the crowd that prefers the safety of Fidelity mutual funds or the steady growth of Apple stock, Nuburu is a nightmare. But for the self-investing enthusiast who spends hours on investing sites and scans every 8K filing on the SEC website, this is a classic deep value or distressed asset play. The company is trading for a fraction of its replacement cost. If you were to try and build a blue laser company with their patents and their military partnerships today, it would cost hundreds of millions of dollars. You can buy the whole thing for $77 million right now on the open market. This is the reality of the small-cap world. Companies often trade for less than the value of their intellectual property